Imagine this for a second. What if the greatest investor of all time, the man who turned a failing textile mill into a trillion-dollar empire, told you that his biggest teacher wasn't success, but mistakes? Not your mistakes, his. Warren Buffett, the Oracle of Omaha, the quiet billionaire who moves markets with a single sentence, openly admits something most investors would never dare say out loud. It's good to learn from your mistakes, but it's better to learn from other people's mistakes. And in this book, The Intelligent Investor's Mistakes, we get something almost no one ever gets access to. A backstage pass into Buffett's 38 real investment screw-ups, the missed opportunities, the bad calls, the emotional decisions, the billion-dollar regrets. This isn't the Warren Buffett polished for CNBC. This is Buffett, unfiltered Buffett as a human being, Buffett as a learner, Buffett as a man who admits he didn't always get it right even when the entire world assumed he did. Now here's why this matters to you. Because hidden inside these mistakes are patterns that separate ordinary investors from extraordinary ones. Patterns that explain why 99% of people lose money in the market, while Buffett keeps compounding at rates most hedge funds can only dream about. This book doesn't ask, how did Warren Buffett succeed? We already know that story. It asks something far more interesting. Where did Warren Buffett fail, and what can we steal from those failures? You'll hear about the companies he shouldn't have bought, the companies he should have bought but didn't, the moments he hesitated, the times he acted too fast, and even the rare moments where ego got in the way of one of the calmest minds in finance. You'll see Buffett losing millions, then billions, but you'll also see how each loss became a stepping stone to a sharper philosophy, a more disciplined strategy, a more ruthlessly rational investor. Because what makes Buffett different isn't perfection. It's his ability to look at a mistake and say, okay, why did this happen, and how do I never repeat it again? This book is not about stock tips. It's about decision-making. It's about human psychology. It's about understanding why smart people do dumb things with money and how to stop yourself before you fall into the same trap. So if you've ever regretted a trade, if you've ever held a stock too long, if you've ever panicked, hesitated, overanalyzed, under-researched, or acted on emotion, congratulations, you and Warren Buffett have something in common. Except now, you don't have to lose billions to learn the lesson. Because this time, the world's greatest investor is handing you 38 shortcuts, 38 stories that reveal the traps, the blind spots, the psychological landmines that even a legend stumbled into. And if you pay attention, if you take these lessons seriously, these mistakes might become your greatest investment advantage. In Chapter 1 of The Intelligent Investor's Mistakes, Balaji Kasal opens the book with the pivotal moment when Warren Buffett acquired ailing textile firm Berkshire Hathaway. This takeover marks more than just a corporate buyout. It's the starting point of one of history's greatest investment sagas, but also the beginning of a long list of hard-earned lessons. At face value, buying a failing textile business seems counterintuitive. The company was sick, competitive environment brutal, and long-term prospects uncertain. Yet Buffett saw more than the current financials. He recognized inefficiency, undervaluation, and the possibility to redeploy capital into better businesses. But that bold bet came with risks and, as Kasal reveals, with mistakes. This chapter doesn't celebrate instant success. Instead, it traces how early misjudgments, overconfidence, and failure to fully appreciate the economic headwinds tested Buffett's conviction. Whether mispricing the textile industry's decline, underestimating structural shifts, or misallocating resources, these early commission errors taught him critical lessons about valuation discipline, business durability, and the importance of capital allocation. More than a cautionary tale, Chapter 1 sets the tone for the entire book. Success in investing isn't just about the wins. It's about learning from the losses. It shows even legends like Buffett began with flawed moves, and how every mistake can be reframed as a lesson. For viewers or readers, this chapter becomes a powerful reminder. The greatest wealth often emerges from surviving and learning through mistakes, not avoiding them. Chapter 2 continues the book's exploration of Warren Buffett's early commission errors, mistakes that came from taking action prematurely or acting on an incomplete understanding of the business. This chapter typically focuses on one specific company from Buffett's early investing years, illustrating how an apparently attractive valuation can mislead even the most disciplined investor. The central theme is misjudging business quality. Buffett, still refining his investment framework, tended to rely heavily on quantitative cheapness, low P/E ratios, discounted book value, and strong-looking assets. In this chapter, the selected company appears undervalued on paper, but the deeper issue revealed to late was the business's eroding competitive position. The chapter highlights how Buffett underestimated industry headwinds, failed to evaluate long-term demand shifts, or overlooked structural disadvantage that management could not fix. Casel uses this example to highlight an important Buffett evolution, moving from cigar-butt investing, buying mediocre businesses at bargain prices, to prioritizing companies with durable economic moats. Chapter 2 shows that buying cheap is not the same as buying well, and that apparent margin of safety can disappear quickly if the business model itself is deteriorating. Another key takeaway is the cost of opportunity loss. By locking capital into a weak company, Buffett not only absorbed direct losses, but also missed the chance to allocate funds into far superior businesses. The chapter explains how this early mistake helped solidify Buffett's later preference for high-quality businesses, even at higher prices, and why he eventually abandoned deep-value traps. Overall, Chapter 2 frames this commission error as a turning point, reinforcing the lesson that price should never overshadow business fundamentals. It teaches viewers that cheap stocks can be expensive when the business has no future, a principle that became central to Buffett's mature investment philosophy. Chapter 3 continues the book's focus on commission errors by examining another early investment, where Warren Buffett made a decision based on numbers that looked compelling but masked critical operational weaknesses. This chapter typically illustrates how over-reliance on historical financial statements can mislead investors when the company's real competitive environment is rapidly shifting. The chapter's core lesson is the danger of misinterpreting short-term strength as long-term durability. Buffett evaluated the company using its past performance, solid margins, consistent revenue, and seemingly stable customer relationships. However, what the financials did not reveal was a business under pressure, emerging competitors, outdated technology, and a management team unable to adapt to structural change. This mismatch between historical data and forward-looking reality created a false sense of safety. Casel frames this mistake as another turning point in Buffett's evolution. The company had strong reported earnings, but lacked a sustainable moat, and Buffett underestimated how quickly the economics of an industry can deteriorate when innovation or disruption accelerates. As the company's fundamentals weakened, the cheap valuation became a trap, forcing Buffett to confront the limitations of purely quantitative value investing. Another theme in this chapter is management quality. Buffett's assumption that competent management could stabilize a declining business proved wrong. This experience influenced his later emphasis on leadership integrity, capital allocation skill, and long-term strategic discipline. The chapter ends by reinforcing a critical investing principle. Past numbers don't guarantee future performance when competitive dynamics are shifting. Buffett's mistake in Chapter 3 helped shape his later insistence on evaluating business models, competitive advantage, and industry trajectory before analyzing price. It's a lesson that warns investors not to rely solely on spreadsheets, but to understand the economic engine powering a company's future. Chapter 4 continues the exploration of Buffett's commission mistakes by presenting a case where he misjudged a company's capital structure and underestimated the long-term consequences of financial leverage. While the exact company in the book is not publicly known, the pattern is consistent with Buffett's early experiences, buying into an undervalued firm without fully appreciating the risks tied to debt, liquidity constraints, and financing decisions made by management. The chapter underscores a key weakness in Buffett's early analytical framework, treating leverage as a secondary factor instead of a core component of business risk. The company he invested in may have appeared fundamentally sound, with steady revenue and decent margins, but the burden of high-interest debt and inflexible financing terms created a fragile balance sheet. when industry pressure increased or cash flow tightened. The company's leverage magnified every operational setback. Casel uses this scenario to illustrate how Buffett learned that financial strength is not just a supporting variable, it is part of the competitive moat. A weak balance sheet can turn an average business into a distressed one quickly, regardless of valuation. Another critical lesson highlighted in the chapter is the importance of management's capital allocation discipline. Buffett assumed the leadership team would allocate cash flow wisely and prioritize debt reduction. Instead, poor decisions expanding too aggressively, maintaining unproductive assets, or delaying restructuring amplified the downside. This experience taught Buffett to evaluate not only the business and its competitive environment, but also its financial architecture. Over time, it reinforced his preference for companies with conservative leverage, predictable cash flow, and management teams who understand the compounding effect of disciplined capital allocation. Chapter 4 ultimately delivers a technical insight. Cheap valuation cannot compensate for balance sheet fragility. The mistake strengthened Buffett's later focus on financial durability as a non-negotiable trait. In long-term investments, Chapter 5 highlights another early-stage commission error in Warren Buffett's investment journey, focusing on a company where he misjudged the relationship between cyclical earnings and true long-term profitability. This chapter typically serves as a reminder that temporary spikes in performance driven by commodity cycles, pricing anomalies, or short-lived demand surges can create misleading valuations and false signals of strength. The business Buffett invested in appeared cheap based on peak earnings. The financials looked attractive: high profit margins, expanding sales, and robust cash flow. However, the company operated in a cycle-prone industry where external forces, not durable competitive advantages, were driving the numbers. When the cycle normalized, the economics of the business deteriorated faster than Buffett initially anticipated. Casel uses this case to emphasize the danger of anchoring on inflated metrics. Buffett overweighted recent financial performance instead of adjusting for mean reversion. The chapter stresses that investors often mistake cyclical highs for structural improvements, leading to flawed valuations and premature confidence in the company's future trajectory. Another key insight is the role of pricing power versus market conditions. Buffett assumed the company's strong margins were the result of operational excellence, when in reality they were largely driven by temporary market imbalances. As competitive pressure rose and pricing returned to normal levels, profitability collapsed, exposing the business's lack of moat. This experience contributed to Buffett's long-term shift toward companies with predictable earnings, stable demand, and economic characteristics not heavily influenced by cycles. It reinforced his preference for buying businesses with intrinsic resilience, rather than those riding temporary macroeconomic waves. Ultimately, Chapter 5 reinforces a technical principle: valuation must be normalized, not optimized around peak conditions. The mistake helped Buffett refine his approach to distinguishing between sustainable economic engines and short-lived earnings surges. Chapter 6 continues the examination of Warren Buffett's early commission errors, this time focusing on the risk of overestimating turnaround potential in declining businesses. The company in this chapter represents a classic value trap, a business appearing cheap due to low market expectations, but fundamentally incapable of reversing long-term structural decline. Buffett's investment was driven by the assumption that operational improvements, new leadership, or strategic restructuring could restore profitability. The stock seemed undervalued relative to assets, and the narrative of a potential turnaround appeared credible. However, what Buffett underestimated was the extent to which the company's decline was structural, not cyclical. Core demand was shrinking, competitors were more efficient, and the company lacked the capital and agility required for meaningful recovery. Casel uses this example to illustrate the analytical pitfall of overweighting management optimism and underestimating industry headwinds. Buffett initially believed that competent managers could overcome adverse market conditions. The chapter emphasizes that even the best operators cannot revive a business whose underlying economics are deteriorating. Another key theme is the difference between operational fixes and economic fixes. While management could cut costs or streamline processes, no amount of efficiency could offset declining market relevance or technological disadvantages. This miscalculation taught Buffett that a turnaround story is often less about managerial execution and more about whether the business model remains viable. This chapter also reinforces the importance of evaluating long-term competitive dynamics rather than focusing on short-term financial recovery. The investment ultimately locked up capital in a company with no real path to sustainable growth, illustrating why Buffett later avoided turnaround situations almost entirely. Chapter 6 concludes with a clear principle: turnarounds rarely turn a lesson. That became central to Buffett's mature investment philosophy and shaped his preference for businesses already winning, not ones trying to recover. Chapter 7 focuses on another commission error in Warren Buffett's early investing years, centering on the risk of misjudging regulatory environments and government-driven business constraints. This chapter typically illustrates how even a fundamentally sound company can become a poor investment when its profitability depends on political decisions, rate controls, licensing rules, or policy volatility that investors cannot forecast reliably. The company Buffett invested in appeared to have stable economics, steady demand, predictable revenue, and strong historical performance. However, a significant portion of its financial stability was tied to regulatory frameworks that were already under review or subject to change. Buffett underestimated how quickly a shift in regulation, often triggered by politics rather than pure economics, could alter the company's earning power. Casel uses this scenario to highlight the analytical mistake of underestimating non-market forces. Buffett's early investment approach was heavily centered on business fundamentals, competitive advantage, and valuation. But in this case, the decisive variables were external: legal constraints, government rate caps, compliance costs, or restrictions that limited the company's ability to price freely or expand operations. Another important insight from the chapter is the danger of relying on historical data. In regulated industries, past earnings often reflect regulatory decisions rather than actual competitive strength. When rules change, the business can quickly lose profitability even if the management team and strategy remain sound. This mistake pushed Buffett to avoid companies whose success hinges on political outcomes, opaque regulatory bodies, or environments where the investor does not control critical risk variables. It strengthened his later focus on businesses with economic durability independent of government influence, such as consumer brands and companies with strong pricing power. Chapter 7 ultimately reinforces a key principle in Buffett's maturing investment philosophy. A great business on paper can be a weak investment if regulation, not competition, determines its economics. Chapter 8 examines another commission error in Warren Buffett's early career, this time centered on misjudging inventory-dependent businesses, companies whose earnings rely heavily on inventory cycles, cost fluctuations, and supply chain timing rather than genuine competitive advantages. The business Buffett invested in appeared financially solid, but the underlying economics were unstable and tied to volatile input costs that management could not reliably control. The chapter highlights a critical analytical mistake: confusing temporary margin expansion with sustainable operating strength. The company's profitability looked impressive at the time of Buffett's purchase, largely due to favorable input prices or inventory bought at low cost. However, these were short-term conditions that masked the business's lack of pricing power. Once costs normalized or competitors adjusted, margins contracted sharply. Casel uses this scenario to illustrate the danger of relying on businesses where profitability depends on buying right rather than having structural advantages. Buffett underestimated how vulnerable inventory-driven companies are to supply shocks, commodity swings, and timing mismatches between procurement and sales cycles. Another key lesson from this chapter is the importance of evaluating working capital intensity. Businesses that require large amounts of inventory tie up cash and expose investors to greater volatility. Buffett discovered that even when such companies appear cheap on earnings, their cash flow is inconsistent, and small errors in forecasting can significantly erode returns. This experience contributed to Buffett's long-term preference for asset-light companies. With strong brand power, recurring demand, and predictable margins, it reinforced the principle that a business dependent on favorable cost cycles is fundamentally weaker than one driven by durable competitive forces. Chapter 8 ultimately strengthens a technical insight that shaped Buffett's mature philosophy. When a company's profitability hinges on inventory timing rather than economic moats, the margin of safety is largely an illusion. Chapter 9 examines another early commission error by Warren Buffett, focusing on the analytical risk of overestimating asset value while underestimating asset productivity. This chapter typically highlights a situation where Buffett purchased a company that appeared attractive due to its substantial tangible assets, factories, equipment, land, or inventory, but whose ability to generate consistent returns from those assets was fundamentally weak. The central mistake lies in treating asset-rich businesses as inherently safer, even when their earnings power is fragile. Buffett initially believed that buying a company with significant physical assets at a discount would provide downside protection. However, the chapter reveals that assets without economic productivity become liabilities. They require maintenance, tie up capital, and often cannot be sold at book value during downturns. Casel uses this example to underscore the difference between asset value and asset utility. While the balance sheet looked strong, the business struggled to convert those assets into sustainable cash flow. Competitive pressure, outdated production methods, and slow asset turnover eroded profitability, making the apparent discount irrelevant. Another critical insight is the danger of ignoring capital intensity. Businesses that require heavy reinvestment just to maintain operations produce lower free cash flow, even if accounting profits look stable. Buffett underestimated the ongoing capital demands and overestimated the company's ability to generate incremental returns. The chapter also touches on the strategic shift this mistake triggered: Buffett's growing preference for intangible asset-driven businesses, brands, distribution networks, customer loyalty, where economic value comes from competitive advantage rather than sheer physical scale. Ultimately, Chapter 9 reinforces a technical lesson central to Buffett's later philosophy. A low price relative to asset value is meaningless if those assets cannot produce high, consistent, and growing returns. This mistake helped shape his long-term move away from asset-heavy, low-return businesses and toward companies built on durable economic engines. Chapter 10 focuses on another key commission error in Warren Buffett's early investing journey, centered on misjudging customer concentration risk. The company highlighted in this chapter initially appeared financially stable, with reliable revenue and consistent historical growth. However, what Buffett failed to fully appreciate was that a significant portion of the company's income depended on one or two major customers, making the business far more fragile than the financial statements suggested. The core analytical mistake was treating concentrated revenue streams as stable, rather than viewing them as a vulnerability. Buffett evaluated the company's past earnings and margins without adjusting for the risk that losing even a single contract could materially damage the business. When competitive pressure increased or a strategic shift occurred from the company's largest customer, revenue fell disproportionately, revealing the structural instability behind the numbers. Casel uses this example to highlight an early lesson for Buffett. Economic strength requires diversified demand, not just historical profitability. The chapter emphasizes that customer concentration is a hidden form of leverage, one that does not show up on the balance sheet, but carries significant operational risk. Another technical insight from Chapter 10 is the danger of overestimating management's ability to replace major customers quickly. Buffett initially believed that strong execution and product quality would secure new business, but the company lacked pricing power and differentiation, making replacement cycles slower and costlier than anticipated. This misstep contributed to Buffett's long-term emphasis on businesses with broad customer bases, strong brand loyalty, and recurring demand that does not hinge on a few large accounts. It reinforced the principle that a company's resilience is determined not just by its financials, but by the diversity and durability of its revenue sources. Ultimately, Chapter 10 delivers a precise investing insight. A company reliant on a handful of customers is not a stable business. It's a concentrated bet disguised as steady earnings. Chapter 11 examines another commission mistake from Warren Buffett's early investment years, focusing on the analytical risk of overestimating the durability of distribution-based businesses. In this chapter, the company Buffett invested in appeared stable because of its extensive distribution network, wide geographical reach, and long-standing relationships with suppliers and retailers. However, Buffett misjudged how vulnerable such businesses are when their value depends on intermediary positioning rather than true competitive advantage. The financials reflected steady revenue and predictable cash flow, but the business model was structurally weak. Distribution companies often operate on thin margins, have limited pricing power, and face constant pressure from both suppliers seeking direct-to-customer channels and retailers demanding lower prices. Buffett underestimated how quickly technological shifts, consolidation in retail, or supplier power dynamics could erode profitability. Casel uses this scenario to highlight a common analytical trap, confusing scale with moat. While a large distribution footprint may look impressive, it rarely provides long-term defensibility unless paired with unique capabilities, proprietary logistics, exclusive contracts, or differentiated service quality. In this case, the company's scale did not translate into meaningful economic power. Another insight emphasized in the chapter is the structural risk of operating leverage. Within distribution businesses, high fixed costs combined with volatile volume can sharply magnify earnings declines. Buffett initially believed volume stability would protect margins, but when competitive pricing intensified, every small reduction in throughput produced disproportionately large drops in profit. This mistake pushed Buffett toward companies with genuine pricing power and away from businesses whose economics depend on being the middleman. It reinforced his long-term preference for companies with direct customer loyalty, strong intangible assets, and control over their value chain. Ultimately, Chapter 11 delivers a precise lesson. A business built on distribution alone is not a durable investment. It is a volume-sensitive model with limited leverage over its own destiny. Chapter 12 analyzes another early commission error in Warren Buffett's investment development, focusing on the risk of misjudging businesses with weak intellectual property and low differentiation. The company in this chapter appeared financially healthy, with consistent sales and a recognizable product line. However, Buffett underestimated how vulnerable the business was due to its lack of proprietary technology, patents, or brand-based pricing power. The core analytical mistake lies in assuming that sales stability equals competitive strength. Even though the company generated steady revenue, its products were easily replicable. Competitors could imitate features, match prices, or undercut distribution costs with minimal barriers. As market pressure intensified, the company's margins eroded quickly, revealing that it had no defensible moat. Casel uses this case to highlight a critical transition in Buffett's investment thinking, moving away from businesses that compete primarily on cost and operational efficiency. Such companies may look stable in good times, but they have no structural advantage when competition increases. Buffett overestimated the company's ability to differentiate its offerings and underestimated how commoditization would reshape the market. Another key lesson from Chapter 12 is the importance of sustainable competitive advantage, rooted in intangible assets. These include brand equity, patents, unique design, or network effects. Buffett realized that a company without these advantages is forced to compete in a race to the bottom, where price becomes the only differentiator, an environment that investors should avoid. The chapter reinforces how this mistake pushed Buffett toward businesses with durable intangibles, such as Coca-Cola, Gillette, and later Apple. It solidified his view that true investment safety comes not from low valuation, but from economic moats that protect long-term earnings power. Ultimately, Chapter 12 delivers a precise investing insight. A company without defensible intellectual property or meaningful differentiation cannot protect its margins, no matter how stable its past performance appears. Chapter 13 examines another commission mistake from Warren Buffett's early investment years, focusing on the analytical risk of misjudging businesses with high customer churn and weak long-term retention. The company highlighted in this chapter had strong initial sales and impressive top-line growth, which made it appear, at first glance, to be a healthy and expanding business. However, Buffett underestimated how fragile the company's economics were due to its inability to retain customers over time. The core mistake lies in relying on revenue growth without understanding the underlying customer behavior. The company attracted many new customers, but retention rates were low because switching costs were minimal, alternatives were abundant, and the product lacked strong loyalty drivers. As a result, the business spent heavily on marketing and sales just to replace lost customers, masking structural weaknesses behind a facade of growth. Casel uses this scenario to emphasize the importance of evaluating unit economics rather than headline revenue. Buffett initially misinterpreted rising sales as evidence of market strength, only to discover later that customer acquisition costs were rising faster than lifetime value. Without repeat purchases or recurring revenue, the business had little compounding power, a trait Buffett eventually prioritized in his mature investing approach. Another key insight from the chapter is the danger of businesses dependent on constant promotion or discounting. Such strategies can temporarily inflate demand but undermine long-term profitability. Buffett underestimated how quickly competitive offers could erode customer loyalty in markets where products are largely interchangeable. This mistake contributed to Buffett's eventual focus on companies with strong recurrence, embedded demand, and customer stickiness, such as insurance, consumer brands, and subscription-based models with predictable renewals. Ultimately, Chapter 13 delivers a clear investment principle. Growth is meaningless without retention. A business that cannot keep its customers cannot compound, no matter how impressive its sales numbers appear. Chapter 14 addresses another of Warren Buffett's early commission mistakes, focusing on the analytical risk of misjudging businesses that rely heavily on external distributors or intermediaries for their sales pipeline. In this case, the company Buffett invested in appeared to have strong sales growth and a healthy presence in its market. However, he underestimated the vulnerability created when a business does not control its own customer access. The central mistake lies in assuming that distribution reach equals competitive advantage. The company depended on third-party distributors, retail partners, or agents who controlled product placement, pricing influence, and end customer engagement. Buffett initially viewed these partnerships as extensions of the company's strengths, but when distributors shifted priorities, demanded better margins, or began favoring competitors, the company's revenue trajectory weakened almost immediately. Casel uses this example to highlight a critical analytical blind spot. Businesses without direct customer relationships are structurally weaker than they appear. Buffett learned that companies reliant on intermediaries lose leverage, have limited pricing power, and struggle to maintain consistent brand positioning. Another key insight in Chapter 14 is the vulnerability created by channel conflict. As competitors introduced better incentives or more attractive products, distributors reallocated shelf space or marketing effort elsewhere. Because the company lacked strong pull-through demand from end consumers, it had little ability to counter these shifts. This mistake influenced Buffett's later preference for companies that own the customer relationship. Businesses with direct brand loyalty, subscription models, proprietary distribution, or unique consumer habits that bypass reliance on third-party channels. Ultimately, Chapter 14 reinforces a precise investment principle. If a company does not control its access to customers, it does not control its future earnings power. Buffett's experience with this mistake strengthened his conviction that durable investing requires businesses with both economic moats and ownership of their demand pipeline. Chapter 15 analyzes another commission error in Warren Buffett's early investing years, focusing on the risk of misjudging businesses with unstable input cost structures and weak ability to pass those costs to customers. The company in this chapter operated in an industry where raw material prices fluctuated significantly, and Buffett underestimated how heavily these fluctuations influenced long-term profitability. On the surface, the company appeared solid, reliable demand, consistent historical margins, and a straightforward production model. However, Buffett misread the company's true economic power. Its cost structure was heavily dependent on commodities or third-party suppliers, whose pricing dynamics were unpredictable. When input costs rose, the company lacked the pricing power to fully pass them along to customers, causing margins to compress sharply. Casel uses this case to highlight a key analytical mistake: evaluating earnings without stress testing the cost structure. Buffett concluded that past margins reflected operational efficiency, but in reality they were largely the product of favorable cost conditions that were unlikely to persist. Once cost pressure intensified, the company's competitive weakness quickly surfaced. Another important takeaway is the distinction between temporary operational efficiency and structural pricing power. While the company managed operations well, it had no durable advantage that allowed it to dictate prices or influence supply. Competitors were similar, customer switching costs were low, and the company existed in a market where economic outcomes were set by suppliers, rather than by competitive moats. This mistake shaped Buffett's long-term preference for companies with stable cost structures, strong pricing power, and business models protected from excessive cost volatility, such as consumer brands, insurance, and companies with intangible-driven economics. Ultimately, Chapter 15 reinforces a precise investing insight. A business that cannot control its costs or pass them through to customers lacks true economic resilience, no matter how efficient it looks on paper. Chapter 16 focuses on another of Warren Buffett's early commission mistakes, centered on the analytical risk of overestimating the stability of businesses. Tied to cyclical capital spending, the company in this chapter operated in a sector where demand for its products or services depended heavily on customers' investment cycles. Industries such as construction, heavy equipment, industrial manufacturing, or energy-related services. Buffett misjudged how unpredictable and volatile these cycles could be. The company's historical revenue appeared strong, and its earnings suggested resilience. However, Buffett underestimated the degree to which the business was exposed to boom and bust patterns, driven by macroeconomic conditions. When capital spending declined even temporarily, the company's revenue collapsed disproportionately, revealing that its earnings power was not as stable as financial statements implied. Casel uses this case to highlight an important analytical blind spot, treating cyclical demand as a stable baseline. Buffett assumed that average historical performance was a dependable indicator of long-term future results, ignoring the fact that the business's customers often delayed or canceled large purchases when economic uncertainty increased. As a result, the company's dependence on external investment cycles made its earnings highly volatile and difficult to forecast. Another key insight emphasized in the chapter is the structural issue of operating leverage. Within capital expenditure-driven businesses, when volumes dropped, fixed costs remained high, causing profitability to deteriorate far faster than revenue. This mismatch explained why the company performed well in expansions, but suffered disproportionately during downturns. This mistake contributed to Buffett's eventual preference for companies with recurring demand, low cyclicality, and business models driven by consumer behavior rather than capital budgets. It reinforced his principle that predictable long-term earnings are more valuable than temporary bursts of profitability tied to economic cycles. Ultimately, Chapter 16 delivers a practical investing insight. Businesses dependent on customers' capital spending are inherently unstable, and the illusion of steady earnings can disappear quickly when the cycle turns. Chapter 17 explores another commission mistake in Warren Buffett's early investing development, centered on the risk of misjudging businesses dependent on short product life cycles and constant innovation cycles. The company featured in this chapter operated in a market where products became outdated quickly, competitive pressure accelerated continuously, and reinvestment requirements were high. Buffett underestimated how these dynamics eroded long-term economic stability. At first glance, the company showed strong revenue growth and impressive historical margins, but the strength was tied to temporary product relevance, not durable competitive advantage. Each product required substantial reinvestment in R&D, marketing, and redesign just to maintain market share. Buffett initially believed the company's track record of launching successful products would carry forward, but he underestimated how rapidly customer preferences and technology were evolving. Casel uses this example to highlight a critical analytical mistake, confusing innovation success with economic durability. Companies in fast-cycle industries may appear dynamic and profitable, yet the underlying economics are fragile because each product has a short window of profitability before competitors catch up. Without strong intellectual property, ecosystem lock-in, or brand dominance, margins are constantly pressured. Another key insight is the relationship between reinvestment intensity and free cash flow. Although the company generated respectable earnings, it consumed a disproportionate amount of capital to remain competitive. Buffett learned that high reinvestment requirements reduce compounding potential, even when revenue appears to be growing. This chapter underscores why Buffett later avoided most technology-driven and fashion-driven industries for decades. Their economics rely on predicting consumer behavior and innovation timing, areas in which Buffett historically considered himself to have no durable edge. Ultimately, Chapter 17 reinforces a precise investing principle. A business that must continually reinvent its products just to stay relevant has weak long-term economics, regardless of how impressive its short-term results may look. Chapter 18 examines another commission error from Warren Buffett's early investment history, centered on the analytical risk of misjudging businesses dependent on aggressive expansion strategies. The company in this chapter looked promising due to rapid store openings, geographic expansion, or branch rollouts, growth indicators that initially appealed to Buffett's interest. In scalable business models, however, he underestimated the risks embedded in expansion-driven earnings. The mistake stemmed from mistaking expansion for true intrinsic growth. The company's financials looked compelling because each new location or unit added short-term revenue and boosted top-line momentum. Yet the underlying economics were weak. Returns on new locations were declining. Market saturation was increasing, and management was using expansion to mask stagnation in the core business. Casel uses this scenario to highlight a common analytical trap. Unit count growth does not equal economic moat. Buffett initially believed the company's rapid expansion was a sign of strong demand and repeatable success. In reality, the model was fragile, dependent on continual openings, promotional incentives, and rising capital expenditure. Once expansion slowed, the weight of growth disappeared and profitability declined sharply. Another key lesson from the chapter is the danger of dilution of operational quality. Fast-growing companies often stretch management oversight, weaken unit economics, or compromise standards just to maintain aggressive growth targets. Buffett underestimated how these operational cracks would compound over time. This mistake influenced his later preference for companies with organic demand, strong same-store sales, and economic models that do not rely on endless expansion to sustain earnings. Durable businesses grow because of pricing power, brand strength, and repeat consumption, not because they continually add new units. Ultimately, Chapter 18 reinforces a critical investing insight. A business that grows only by expanding its footprint is not compounding. It is spending capital to chase temporary growth. Chapter 19 explores another commission error in Warren Buffett's early investing approach, this time centered on the risk of misjudging companies dependent on single-product economics. The business in this chapter generated the majority of its revenue and profit from one flagship product or a small cluster of closely related offerings. Buffett initially saw this as a sign of specialization and operational focus. However, he underestimated the concentration risk embedded in such a narrow product portfolio. The financials looked strong. The core product had solid margins, steady demand, and long-standing market acceptance. But Casel illustrates how dangerous it is when the fate of a company hinges on one product's life cycle, competitive environment, or regulatory exposure. As soon as competition intensified, consumer preferences shifted, or technological alternatives emerged, the company's economics deteriorated sharply. The core analytical mistake was treating product concentration as stability rather than fragility. Buffett initially believed that a strong product would provide a durable foundation for long-term performance. In reality, the lack of diversification multiplied risk. Any disruption to the flagship product impacted revenue, margins, and cash flow all at once. Another key insight from the chapter is the danger of underestimating substitution risk. In markets where alternatives are abundant or innovation is rapid, even a leading product can lose relevance quickly. Buffett realized that the company lacked the brand strength, ecosystem advantages, or R&D capabilities necessary to defend its lead over time. This experience contributed to Buffett's later preference for companies with broad product lines, diversified revenue streams, and multiple reinforcement points. Businesses that do not depend on the success of a single offering. Ultimately, Chapter 19 underscores a precise investing principle. A company built around one dominant product may look efficient, but it is structurally exposed. One disruption can unravel its entire economic engine. Chapter 20 addresses another commission error in Warren Buffett's early investment journey, focusing on the analytical risk of overestimating geographic expansion as a durable growth strategy. The company highlighted in this chapter demonstrated strong international revenue growth, rapidly entering new markets, and reporting rising sales across multiple countries. Buffett initially viewed this as a sign of a scalable business model with global appeal. However, he underestimated the structural challenges inherent in cross-border expansion. The mistake stemmed from treating geographic diversification as economic diversification. While the company appeared to be spreading its risk across regions, its core value proposition was not strong enough to ensure sustained success in highly competitive or culturally distinct markets. Expansion masked weaknesses rather than solving them. Inconsistent regulatory environments, fragmented consumer preferences, and high localization costs. Casel uses this example to emphasize that international growth often magnifies operational flaws. Buffett must judge the company's capability to adapt its product, pricing, and distribution strategy across different markets. As competition intensified abroad and foreign operations became more expensive, profitability deteriorated even as top-line revenue continued to rise. Another key insight centers on execution complexity. Managing logistics, supply chains, and compliance across multiple jurisdictions created structural inefficiencies that eroded the company's margins. Buffett initially believed managerial reputation and past domestic success would translate globally, but underestimated the challenges of running a multi-country footprint without a strong underlying moat. This experience reinforced Buffett's long-term preference for companies whose global success stems from brand power, universal consumer demand, and scalable economics, not from aggressive international expansion alone. Ultimately, Chapter 20 delivers a clear investing principle. Geographic expansion is not a moat if a company lacks intrinsic competitive strength at home. Expanding abroad only increases cost, complexity, and risk. Chapter 21 highlights another commission error in Warren Buffett's early investing, focusing on the analytical risk of misjudging companies dependent on unstable supplier ecosystems. In this case, the company operated in a business where supply continuity, input quality, and delivery reliability were heavily controlled by third-party providers. Buffett underestimated how fragile the business model was when key suppliers held disproportionate power. On paper, the company appeared operationally efficient, with predictable output and consistent historical margins. However, Casel emphasizes that the economics were artificially stable because the supplier environment had been unusually favorable for several years. Once suppliers increased prices, faced capacity shortages, or shifted priority to larger customers, the company's cost structure and production reliability deteriorated sharply. The core analytical mistake was assuming supply chain stability without examining dependency concentration. Buffett relied too heavily on backward-looking financial data that did not capture supplier bargaining power, cost escalation risk, or the company's limited ability to switch vendors. When supply disruptions hit, the business exposed its structural weakness immediately. Another key insight from the chapter is the importance of evaluating bargaining leverage. Companies with small order volumes, undifferentiated products, or minimal strategic importance to their suppliers rarely control their input economics. Buffett realized that the company lacked the scale, brand importance, or technological uniqueness required to negotiate favorable long-term contracts. This mistake shaped Buffett's later preference for businesses where supply chains support, rather than threaten, economic durability. He increasingly favored companies with diversified suppliers, vertical integration, or strong pricing power that allowed them to offset input fluctuations. Ultimately, Chapter 21 reinforces a critical investing principle. If a company cannot control or influence its supply chain, it cannot control its cost structure, and therefore cannot control its long-term earnings power. Chapter 22 examines another commission error in Warren Buffett's early investing approach, centered on the analytical risk of overestimating businesses. Built on temporary regulatory advantages, the company in this chapter benefited from favorable rules, incentives, or protections that created the appearance of stable profitability. Buffett initially viewed these advantages as durable components of the business model, but underestimated how dependent the company was on political and regulatory conditions outside its control. Although the financial statements reflected strong margins, healthy cash flow, and a robust market position, these results were significantly influenced by regulatory tailwinds such as preferential licensing, subsidies, tariff protections, or exclusive operating permissions. Casel illustrates how these advantages can be misleading because they do not originate from economic competitiveness, but from policy choices that can shift abruptly. The central analytical mistake was treating regulatory privilege as a moat. Buffett overlooked the inherent fragility of a business whose success relied on maintaining government-approved benefits. When regulations changed, whether due to political pressure, market liberalization, or administrative reform, the company's economics deteriorated quickly, erasing what once appeared to be a substantial competitive edge. Another critical insight from the chapter is the danger of failing to analyze normalized earnings. Without regulatory support, Buffett later recognized that companies dependent on artificial protections rarely sustain long-term returns because competition eventually enters once barriers are removed. This mistake influenced his shift toward businesses whose moats are intrinsic brand value, customer loyalty, pricing power, network effects, not those constructed by temporary external rules. Ultimately, Chapter 22 reinforces a precise investing principle. A company protected by regulation is not the same as a company protected by economics. When regulation shifts, only true competitive strength survives. Chapter 23 focuses on a commission mistake rooted in misjudging businesses that depend on short-term contractual revenue rather than long-term economic relationships. The company Buffett invested in showed strong revenue growth and solid profitability, but much of that revenue came from contracts with limited duration, variable renewal terms, and customers who could easily switch to competitors. Buffett underestimated how fragile these contractual arrangements were when not backed by strong switching costs or durable service differentiation. The financials appeared impressive: recurring billings, consistent renewal cycles, and a broad customer list. However, Casel highlights the structural weakness: these contracts did not guarantee long-term commitment. Many renewals depended on price negotiations, competitive bids, or temporary customer needs. When market conditions tightened or alternative providers offered discounts, renewal rates dropped sharply, exposing the company's lack of loyalty-based retention. The central analytical mistake was treating contract-driven revenue as equivalent to true recurring revenue. Buffett initially assumed that historical renewal patterns would continue, but he overlooked the competitive sensitivity of the company's offerings. The business lacked deep integration with customers' operations, meaning it could be replaced without meaningful disruption. Another key insight in this chapter is the importance of evaluating the economic glue between a company and its clients. Businesses with mission-critical products, embedded workflows, or high switching costs retain customers because leaving is painful, not because contracts dictate it. Buffett learned that contractual renewal is a weak moat if the product itself is not essential. This mistake directly informed Buffett's long-term preference for companies with sticky demand, customer dependency, and economic lock-in, such as insurance, consumer brands, and businesses with built-in repeat behavior. Ultimately, Chapter 23 reinforces a precise investing principle. Revenue that renews on paper is not the same as revenue that renews by necessity. Only the latter forms a true economic moat. Chapter 24 highlights another commission mistake in Warren Buffett's early investing phase, centered on the analytical risk of overestimating the resilience of businesses dependent on cyclical consumer sentiment. The company in this chapter operated in a sector where demand rose and fell sharply based on consumer confidence, discretionary income, and broader macroeconomic conditions. Buffett initially viewed the company's historical growth as a sign of stable consumer preference, but underestimated how sensitive the business was to shifts in sentiment. The company's financials appeared strong, rising sales, robust margins, and seemingly loyal customers. However, Casel illustrates how misleading these metrics can be when they occur during periods of economic optimism. As soon as consumer confidence weakened, whether due to employment concerns, interest rate increases, or macro uncertainty, the company's sales dropped significantly, revealing that its customer base was not structurally loyal but economically elastic. The central analytical mistake was treating discretionary demand as durable demand. Buffett initially assumed the company's strong past performance reflected competitive strength. In reality, the underlying economics were tied to spending behavior that could evaporate quickly when household budgets tightened. Another key lesson from the chapter is the vulnerability created by high operating leverage. Businesses tied to discretionary spending often maintain fixed cost structures, such as retail leases, staffing, or production commitments, that magnify declines in revenue. Buffett underestimated how quickly earnings could collapse when consumer sentiment turned downward. This mistake ultimately contributed to Buffett's long-term preference for businesses with needs-based demand, recurring consumption, and products tied to habit rather than emotion, such as beverages, groceries, and insurance. Chapter 24 reinforces a precise investing principle. If a company's demand depends on how consumers feel rather than what they need, its earnings are not predictable, and unpredictability destroys long-term compounding. Chapter 25 examines another commission error in Warren Buffett's early investing experience, this time focusing on the analytical risk of misjudging businesses reliant on promotional-driven sales cycles. The company in this chapter appeared to have strong revenue and market presence, but much of its performance depended on discounts, incentives, seasonal promotions, and constant marketing spend to drive short-term demand. Buffett underestimated how artificial and fragile these revenue streams were. The financials showed robust top-line growth and consistent quarterly sales spikes. However, Casel highlights how these metrics masked the underlying weakness. True customer demand was shallow, and the company relied on promotional pressure rather than organic pull-through. When promotions slowed or when competitors increased their own incentives, sales collapsed faster than Buffett anticipated, revealing the absence of a durable customer base. The core analytical mistake was treating promotional-driven revenue as evidence of strong market fit. Buffett initially believed high sales volume reflected consumer preference. In reality, customers were responding to discounts, not loyalty. The business had no pricing power, weak brand differentiation, and an inability to maintain margins without sacrificing profitability. Another key insight is the operational fragility of companies that depend on continuous marketing spend. Heavy reliance on advertising or promotions to sustain revenue creates a cost structure that scales upward faster than organic demand. Buffett underestimated how this dynamic would compress margins and reduce free cash flow, even during periods of apparent revenue growth. This experience reinforced Buffett's later preference for companies with inherent demand drivers, where products sell due to habit, necessity, or brand attachment, not because customers are enticed by temporary incentives. Ultimately, Chapter 25 delivers a clear investing principle. If a business needs constant promotions to generate sales, it doesn't have customers. It has transactions, and transactions do not build long-term economic value. Chapter 26 highlights another commission error in Warren Buffett's early investment process, centered on the analytical risk of misjudging companies with overly complex corporate structures. The business featured in this chapter operated through multiple divisions, subsidiaries, and layered reporting systems. Buffett initially believed that diversification across several business lines reduced risk. However, he underestimated how structural complexity can obscure true economics, weaken managerial accountability, and hide deteriorating performance. At first glance, the company appeared stable, diversified revenue streams, broad market presence, and consistent consolidated earnings. But Casel emphasizes the core blind spot. Complexity makes it difficult to identify where value is actually created or destroyed. Within the company, strong units were masking weak ones, and capital was being inefficiently allocated without clear visibility into return profiles. The central analytical mistake was treating diversification as a proxy for safety. Buffett initially assumed that multiple business lines insulated the company from market volatility. In reality, the complexity prevented management from focusing, diluted competitive strength, and created bureaucratic inertia that slowed decision-making. Another key insight from this chapter is the problem of misaligned incentives. Within multi-division companies, individual unit managers often prioritize divisional targets over company-wide value creation, leading to inefficient spending, overexpansion, or underperformance that becomes difficult to detect early. Buffett underestimated how these internal dynamics undermined operational discipline. This experience later influenced Buffett's strong preference for companies with simple business models, transparent financials, and focused economic engines. He repeatedly emphasized that you should never invest in a business you cannot understand, a principle shaped in part by mistakes like the one in Chapter 26. Ultimately, the chapter underscores a precise investing lesson. Complexity is not diversification. When a business becomes too complicated to analyze cleanly, its true economics become harder to trust and harder to compound. Chapter 27 examines another commission mistake in Warren Buffett's early investment evolution, centered on the analytical risk of misjudging companies whose economics depend heavily on cyclical advertising markets. The business in this chapter operated in a sector where revenue was closely tied to advertisers' spending habits, a category notoriously influenced by macroeconomic conditions, competitive pricing, and shifting marketing trends. Buffett initially viewed its strong advertising demand as a sign of stable long-term value, but underestimated the volatility embedded in the model. The financial statements showed attractive margins, predictable cash flow, and a history of recurring ad placements. However, Casel highlights how these indicators masked a deeper weakness. Advertising is one of the first expenditures companies cut during economic downturns. When the market softened, the company's revenue fell disproportionately fast, exposing structural instability. The core analytical mistake was treating advertising demand as steady rather than highly elastic. Buffett initially believed the company's loyal advertiser base reflected strong competitive positioning. In reality, advertisers could shift budgets quickly to competing platforms, alternative media formats, or lower-cost digital channels. The business lacked the pricing power or differentiation needed to retain budget commitments during volatile cycles. Another key insight from this chapter is the danger of overestimating historical renewal rates. Buffett misjudged how fragile advertiser loyalty was when new media technologies emerged, or when competitors undercut pricing. The company had no defensible moat. Its demand depended on external marketing decisions, not intrinsic customer stickiness. This experience shaped Buffett's long-term preference for businesses with demand driven by consumer necessity, habit, or structural contracts, rather than discretionary marketing budgets. Ultimately, Chapter 27 reinforces a clear investing principle. If a company's revenue depends on advertisers' moods, trends, or budgets, its earnings are not durable, and undurable earnings cannot compound reliably. Chapter 28 explores another commission mistake from Warren Buffett's early investing journey, focusing on the analytical risk of misjudging businesses dependent on fragmented and highly competitive distribution channels. The company featured in this chapter relied on retailers, wholesalers, or independent agents across numerous small markets. Buffett initially believed that broad market reach signaled strong demand, but he underestimated how structurally weak such decentralized distribution models can be. At first glance, the company showed consistent revenue across multiple regions, suggesting diversification and operational stability. However, Casel emphasizes that fragmentation often hides deep vulnerabilities. Because each channel partner had limited loyalty, minimal incentive alignment, and low switching costs, the company had little control over pricing, product placement, or end customer experience. Competitive products could easily displace its offerings through minor rebates or better terms. The core analytical mistake in this chapter was assuming that wide distribution equals competitive strength. Buffett overlooked the fact that the company did not own its customer relationships. As distribution partners rotated inventory based on margin pressure or supplier bargaining, the company experienced unpredictable sales swings. This volatility did not show up in annual financial statements, but became obvious in operational performance. Another key insight relates to the cost of managing a fragmented network. Maintaining broad distribution required high coordination expenses, complex logistics, and continuous incentive programs. Buffett underestimated how these structural costs compressed margins and diluted returns, particularly when the business lacked a brand strong enough to command preferential placement. This mistake helped shape Buffett's later preference for businesses with direct-to-customer models, strong brand pull, or vertically integrated distribution, where control over demand translates into durable economics. Ultimately, Chapter 28 reinforces a sharp investing principle. Distribution breadth without distribution control is not an advantage. It is a liability that erodes pricing power, predictability, and long-term compounding. Chapter 29 analyzes another commission mistake in Warren Buffett's early investment learning curve, centered on the risk of misjudging businesses with weak after-sales economics and high post-purchase support burdens. The company in this chapter generated strong initial sales, but a substantial portion of its long-term profitability depended on service contracts, warranties, parts replacements, or customer support infrastructure. Buffett underestimated how expensive and unpredictable these downstream obligations would become. At first glance, revenue growth looked solid and unit sales were rising. However, Casel highlights a core weakness. The business model relied heavily on costly after-sales support, often underpriced to win customers. As products aged or failures increased, the company absorbed large service expenses that far exceeded original estimates. These obligations were not fully reflected in upfront financials, causing Buffett to misread the company's true economic engine. The central analytical mistake was treating product sales as the primary profitability driver, when in reality, the after-sales life cycle determined long-term returns. Buffett initially assumed that service operations were ancillary. Instead, they became a source of margin erosion, revealing operational fragility and poor cost forecasting. Another key insight in this chapter is the challenge of underestimating lifetime cost liabilities. Companies with high warranty exposure, complex maintenance needs, or long-term service commitments often face unpredictable expenses that distort free cash flow. Buffett failed to recognize how these obligations could turn profitable sales into long-term financial drag. This mistake pushed Buffett toward companies with simple cost structures, minimal post-purchase liabilities, and economics that do not depend on uncertain future maintenance demands, such as consumer products with low service intensity and insurance businesses with carefully priced risk models. Ultimately, Chapter 29 reinforces a precise investing principle. If a company cannot accurately predict the long-term cost of supporting what it sells, its earnings cannot be trusted, and unreliable earnings destroy compounding. Chapter 30 focuses on another commission error in Warren Buffett's early investment approach, centered on the risk of misjudging businesses dependent on inconsistent or non-recurring government or institutional contracts. The company in this chapter generated a significant portion of its revenue from large, irregular contracts with public agencies, educational systems, municipalities, or institutional buyers. Buffett initially viewed these contracts as stable anchors of revenue, but he underestimated their unpredictability and fragility. The financial performance looked promising: multi-year agreements, sizable contract values, and high reported visibility. However, Casel highlights a structural weakness often hidden within contract-based businesses: institutional. Spending is cyclical, politically influenced, and budget-dependent. Changes in leadership, fiscal tightening, or reallocation of funds can abruptly halt or cancel contracts, regardless of past performance. The core analytical mistake was treating institutional contracts as equivalent to predictable, recurring demand. Buffett assumed that long-standing relationships would translate into continued business. Instead, he learned that institutional customers prioritize budget constraints and bidding processes over loyalty, making renewal far less dependable than it appeared. Another key insight from the chapter is the vulnerability created by long sales cycles and concentrated awards. Losing even one major contract could materially impact revenue, while securing new ones required lengthy negotiations and high administrative costs. Buffett underestimated how these structural dynamics reduced operational flexibility and introduced earnings volatility. This mistake later informed Buffett's shift toward companies that rely on consumer-driven demand, recurring usage patterns, and business models insulated from political or budget-driven uncertainty. Ultimately, Chapter 30 reinforces a precise investing principle: revenue supported by government or institutional budgets is not true recurring revenue. It is conditional, contestable, and highly unstable as a foundation for compounding. Chapter 31 explores another commission mistake in Warren Buffett's early investing journey, focusing on the analytical risk of misjudging businesses with weak capital allocation discipline. The company featured in this chapter generated stable earnings and appeared financially healthy, but Buffett underestimated how destructive poor management decisions could be when leadership consistently misallocated retained earnings. Although the company produced steady profits, Casel highlights a deeper structural issue: management reinvested capital into low-return projects, unnecessary expansions, or acquisitions that lacked strategic coherence. Buffett initially viewed retained earnings as a positive sign of growth potential. Instead, he discovered that retained capital only creates value when management deploys it intelligently. The core analytical mistake was assuming that profitability automatically leads to value creation. Buffett misjudged the management team's ability to allocate capital effectively, and he overlooked red flags such as declining return on invested capital, inconsistent project performance, and acquisitions driven by ambition rather than economics. As poor capital allocation accumulated, the company's intrinsic value eroded even though headline earnings remained stable. Another key insight in this chapter is the danger of businesses that retain too much capital instead of returning it to shareholders. When management lacks discipline, retained earnings become a liability, funding missteps, bloated operations, or diversification attempts that dilute the core franchise. Buffett later recognized that the problem was not the company's industry, but the leadership's inability to compound value. This mistake strongly influenced his long-term preference for companies led by rational capital allocators, leaders who reinvest selectively, maintain high return thresholds, and return excess cash through dividends or buybacks when appropriate. Ultimately, Chapter 31 reinforces a critical investing principle: a business is only as good as the people allocating its capital. Strong earnings mean nothing if management destroys value with every dollar retained. Chapter 32 addresses another commission error in Warren Buffett's early investing development, centered on the analytical risk of misjudging businesses whose economics rely heavily on unstable partnership or joint venture structures. The company in this chapter operated through shared ownership arrangements, co-developed products, or revenue-sharing contracts where strategic control was divided among multiple parties. Buffett initially perceived these partnerships as a way to reduce risk and expand market reach, but he underestimated how these structures could create long-term instability. At a surface level, the company's financials looked strong: diversified offerings, shared investment burdens, and access to new markets through partner networks. However, Casel underscores the structural flaw: joint ventures often dilute accountability. slow decision-making, and misaligned incentives. As partners pursued conflicting objectives, operational execution weakened and strategic initiatives lost coherence. The core analytical mistake was treating shared ownership as a strength rather than a constraint. Buffett initially believed that spreading operational responsibility would enhance resilience. Instead, he learned that lack of unified control made it difficult to maintain consistent strategy, enforce discipline, or respond quickly to market changes. When tensions escalated between partners, overpricing, capital needs, or product direction, business performance deteriorated rapidly. Another key insight from this chapter is the danger of dependence on partners for critical capabilities. When a company relies on another entity's technology, distribution, or brand, it loses negotiating leverage. Any breakdown in the partnership can significantly disrupt operations. Buffett underestimated how fragile these relationships become when economic conditions shift. This mistake influenced his long-term preference for businesses with full control over their value chain, strong internal capabilities, and governance structures that ensure aligned incentives. Ultimately, Chapter 32 reinforces a sharp investing principle. A company that does not fully control its strategy cannot fully control its economics. And what it cannot control, it cannot compound. Chapter 33 examines another commission error in Warren Buffett's early investment learning curve, centered on the analytical risk of misjudging businesses. Dependent on aggressive financial engineering rather than operational strength, the company in this chapter reported attractive earnings, rising returns on equity, and a seemingly efficient capital structure. However, Buffett underestimated how much of this performance was driven by leverage, accounting adjustments, and short-term optimizations rather than true economic productivity. At first glance, the financial metrics were impressive. High ROE, efficient asset turnover, and strong bottom-line growth painted the picture of a disciplined and high-performing business. But Casel highlights the structural flaw. These metrics were artificially inflated by debt-fueled buybacks, asset reevaluations, or temporary cost deferrals, not by the underlying strength of the business model. The central analytical mistake was failing to separate genuine operating performance from engineered financial appearance. Buffett initially assumed the company's capital efficiency reflected superior management. Instead, the business had become increasingly fragile, with rising leverage, heightened refinancing risk, and low-quality earnings supported by accounting tactics rather than sustainable cash flow. Another key insight from this chapter is the danger of earnings not backed by real cash generation. Buffett later recognized that apparent profitability means little if free cash flow is weak, inconsistent, or dependent on non-operating adjustments. When economic conditions shifted or credit tightened, the company's financial strategy unraveled quickly, revealing its lack of operational resilience. This mistake strongly influenced Buffett's eventual rule to avoid businesses whose success relies on leverage or financial manipulation. He gravitated toward companies with clean balance sheets, transparent economics, and earnings that reflect true business performance, not financial engineering. Ultimately, Chapter 33 reinforces a precise investing principle. Financial engineering can make a weak business look strong, but only temporarily. Real compounding requires real economics, not accounting magic. Chapter 34 highlights another commission error in Warren Buffett's early investment progression, focusing on the analytical risk of misjudging businesses with structurally weak corporate governance and poor oversight mechanisms. The company in this chapter operated under a management team with limited accountability, minimal board independence, and incentive systems that encouraged short-term performance rather than long-term value creation. Buffett initially underestimated how governance failures could compound operational and financial weaknesses. On the surface, the company delivered stable earnings and appeared well-managed. However, Casel underscores the structural flaw. Weak governance often conceals deeper inefficiencies, including inflated expenses, undisciplined capital deployment, and opaque reporting. Without strong oversight, management may pursue projects that enhance personal influence or short-term optics, rather than shareholder value. The core analytical mistake was assuming that acceptable financial performance equates to sound managerial behavior. Buffett initially believed that historical results validated the leadership's competence. In reality, misaligned incentives led to strategic drift, unnecessary diversification, and a lack of accountability for underperforming segments. As governance issues accumulated, the company's intrinsic value eroded despite superficially stable financial statements. Another key insight from this chapter is the danger of opaque reporting structures, where critical information is withheld, distorted, or aggregated in ways that mask economic deterioration. Buffett underestimated how difficult it is for investors to evaluate a company accurately when transparency is compromised, and how management can exploit that opacity to delay or obscure structural problems. This mistake helped shape Buffett's strong long-term preference for companies with high-integrity leadership, transparent metrics, and governance frameworks that align management with shareholders. He frequently emphasized that good managers are worth more than good assets because they protect compounding. Ultimately, Chapter 30 reinforces a fundamental investing principle. Without governance discipline, even a decent business becomes vulnerable. Poor oversight destroys value quietly, consistently, and often irreversibly. Chapter 35 highlights another commission error in Warren Buffett's early investment development, focusing on the analytical risk of misjudging businesses built on volatile or non-durable distribution partnerships with key suppliers. In this case, the company's success depended heavily on exclusive or semi-exclusive agreements that granted it access to premium products, specialized inventory, or favorable supply terms. Buffett initially viewed these partnerships as competitive strengths, but underestimated how unstable and temporary such relationships can be. The company's historical performance looked strong: steady margins, reliable supply, and a growing customer base. However, Casel emphasizes a critical structural weakness. Supplier partnerships are not true moats if the supplier holds the bargaining power. In this situation, the supplier could renegotiate terms, increase pricing, or shift distribution rights to other partners, leaving the company with diminished leverage and deteriorating economics. The core analytical mistake was treating supplier preference as an enduring strategic advantage. Buffett misjudged the asymmetry in the relationship. The supplier had multiple distribution alternatives, while the company was overly dependent on a single channel of premium inventory. Once the supplier changed strategy or reprioritized partners, the company's margins, volume, and customer perception weakened rapidly. Another key insight from this chapter is the risk of overestimating operational strength that is actually borrowed rather than owned. Businesses that rely on someone else's brand, inventory, or product-level differentiation have limited control over their value chain. Buffett overlooked how fragile the economics become when critical inputs are not secured through ownership, contracts with long-term durability, or vertically integrated capabilities. This mistake shaped Buffett's later preference for companies that own their competitive advantages, whether through brand equity, intellectual property, or full control of their supply chain. Ultimately, Chapter 35 reinforces a precise investing principle. If a company's strength comes from a partner rather than itself, that strength can disappear, and so can its economics. Chapter 36 examines another commission mistake in Warren Buffett's early investment decision-making, centered on the analytical risk of misjudging businesses overly dependent on cyclical B2B demand, rather than end-consumer pull. The company in this chapter generated most of its revenue by selling to other businesses, rather than directly to consumers. Buffett initially viewed its strong order volumes and long-standing commercial relationships as evidence of durable demand. However, he underestimated how vulnerable these relationships were to industry cycles, budget constraints, and strategic shifts among corporate buyers. On paper, the business looked reliable: predictable contract volumes, steady revenue, and a robust sales pipeline. But Casel emphasizes the deeper flaw. B2B demand can evaporate rapidly when downstream industries tighten spending. The company's customers prioritize their own cost-cutting during downturns, delaying purchases or switching to lower-cost alternatives. As a result, the company's revenue fell sharply even though end consumer demand appeared stable. The central analytical mistake was confusing supplier integration with customer loyalty. Buffett misjudged the company's position in the value chain. Although embedded in corporate workflows, the company lacked true switching barriers. Competitors could easily replace it with similar offerings, and customers had little incentive to maintain long-term commitments. Another important insight is the risk of misreading revenue visibility in B2B pipelines. Forecasted orders often looked firm but were subject to approval cycles, budget revisions, or strategic pivots. When conditions changed, cancellations surged. Buffett underestimated how dependent the business was on macro sentiment rather than product indispensability. This mistake later reinforced Buffett's preference for companies with consumer-driven demand. Habitual usage patterns and economic moats drive from brand or necessity, not from corporate procurement cycles. Ultimately, Chapter 36 reinforces a clear investing principle. If a business depends on other businesses' budgets rather than consumer behavior, its revenue is discretionary, and discretionary revenue cannot compound reliably. Chapter 37 highlights another commission error in Warren Buffett's early investment development, focused on the analytical risk of misjudging businesses whose economics depend on unpredictable technology adoption curves. The company in this chapter operated in a sector where customer adoption of new technology was inconsistent, slow, or highly segmented. Buffett initially interpreted early traction as an indicator of scalable long-term demand, but underestimated the volatility inherent in technology-driven adoption. On the surface, the business appeared promising: rising sales, strong early customer interest, and a growing pipeline of potential buyers. However, Casel underscores the deeper structural problem. Tech adoption rarely follows a straight line. Early adopters generate enthusiasm that may not translate into mainstream demand. Buffett misread early enthusiasm as durable traction, failing to recognize how skepticism, integration complexity, or competing standards would slow broader adoption. The core analytical mistake was treating initial momentum as evidence of mass market viability. Buffett assumed that the company's technology would scale naturally because it performed well for early users. In reality, the business faced barriers such as high switching costs, uncertain long-term support, regulatory ambiguity, and rapidly evolving alternative solutions. These factors collectively suppressed mass market acceptance. Another key insight from this chapter is the danger of overestimating product stickiness. In emerging technology markets, without a dominant standard, strong ecosystem, or powerful lock-in mechanisms, the company was vulnerable to displacement. Buffett underestimated how quickly technological relevance can fade. When the market shifts toward newer, cheaper, or more integrated alternatives, this mistake reinforced Buffett's long-term skepticism of most technology-driven investments, especially those requiring widespread adoption to achieve profitability. It helped shape his preference for businesses with predictable consumer behavior, long-established demand, and economic moats independent of shifting technological trends. Ultimately, Chapter 37 delivers a decisive investing principle. A business reliant on uncertain technology adoption cannot offer reliable compounding. Initial traction is not the same as durable demand. Chapter 38 concludes the series of commission errors by examining a critical analytical mistake: overestimating the long-term economics of businesses dependent on network effects that never fully materialized. The company in this chapter operated in a market where success depended on achieving a large user base, ecosystem adoption, or platform scale. Buffett initially believed the business had early signs of momentum, but he underestimated how difficult it is to achieve true, self-sustaining network effects. The company showed promising early indicators: rising user counts, expanding partner participation, and optimistic projections about future adoption. However, Casel highlights a fundamental structural weakness. Partial network effects are not real moats. If a platform does not reach critical mass, users have little incentive to stay. Switching costs remain low, and competitors can easily lure participants with better incentives or functionality. The core mistake was confusing early traction with inevitability. Buffett initially assumed that once a platform begins growing, compounding would naturally follow. Instead, the business became stuck in a subscale plateau, where growth slowed, engagement declined, and network density was too low to generate meaningful value for participants. Another key insight from this chapter is the two-sided fragility of platform businesses. For many platform models, both sides, users and partners, wait for the other to scale first. Buffett underestimated how expensive and uncertain it was to maintain momentum in such an environment. Without dominant share or unique value creation, the platform could not sustain engagement, leading to deteriorating economics. This mistake solidified Buffett's inclination to avoid businesses whose success depends on speculative scale, especially when they lack tangible moats, strong cash flow, or predictable demand patterns. Ultimately, Chapter 38 reinforces a decisive investing principle. A platform without critical mass has no moat. Network effects that never fully form become liabilities, not advantages, and investments based on them rarely compound. The Intelligent Investor's Mistakes presents a rare and valuable angle on Warren Buffett's career. Not his legendary wins, but the 38 mistakes that shaped his investment philosophy. Across these chapters, Balaji Kasal highlights the decisions Buffett made, why they failed, and how each misstep refined the principles that later defined Berkshire Hathaway's long-term compounding engine. The overarching message is clear. Buffett didn't become Buffett because he avoided mistakes. He became Buffett because he studied them, systemized them, and never repeated them. Throughout the 38 commission errors, several consistent themes emerge. 1. Not all cheap companies are value opportunities. Buffett repeatedly learned that low valuation metrics mean little. When the underlying business has weak economics, cheapness cannot compensate for lack of moat, structural decline, or fragile demand. Many early mistakes came from over-relying on book value, P/E ratios, or asset counts while underestimating real competitive durability. 2. Management quality matters more than spreadsheets. Several investments suffered because leaders misallocated capital, expanded too aggressively, relied on financial engineering, or lacked strategic discipline. Buffett's biggest shift came when he realized, you're not buying stocks, you're buying management teams. 3. Complexity destroys returns. Buffett learned to avoid businesses with layered subsidiaries, joint ventures, fragmented operations, or unclear economics. Complexity hides problems, confuses incentives, and prevents rational capital deployment. Simplicity became a cornerstone of his later investing strategy. 4. Demand predictability is the backbone of compounding. Mistakes showed that companies tied to cyclical spending, discretionary budgets, promotions, or unstable adoption curves were too unreliable to compound over decades. Buffett ultimately gravitated toward businesses driven by habit, necessity, and consumer repeat behavior. 5. Economic moats matter more than historical performance. Whether it was weak IP, poor switching costs, fragile distributor networks, or incomplete network effects, Buffett learned that history means nothing without a moat that protects the future. The book emphasizes how he transitioned from chasing undervalued companies to owning high-quality businesses at fair prices. 6. Dependency on suppliers, customers, partners, or regulators is dangerous. Buffett's mistakes revealed how little control investors have when a company's economics rely on entities outside its influence. Over time, he favored companies with ownership of their supply chain, distribution, pricing power, and customer relationship. Collectively, these lessons formed Buffett's enduring philosophy. Buy wonderful businesses at fair prices. Avoid fair businesses at wonderful prices. His mistakes were not setbacks, they were tuition. The book's value lies not in the details of each company, but in the patterns. Avoid leverage-driven growth. Distrust unsustainable channels. Beware of industries without durable economics, and always prioritize long-term moats over short-term metrics. Ultimately, The Intelligent Investor's Mistakes is not about Warren Buffett's failures. It's a blueprint for avoiding your own. If you found this breakdown valuable, don't leave without hitting subscribe. This channel turns the world's most important finance books into clear, actionable insights so you can think smarter, invest better, and build real financial freedom. Click like to support the channel. Drop a comment with the next book you want summarized. And if you want to level up your financial intelligence, stick around. The next video might change the way you invest forever.